Welcome to Academic Gain Tutorials. In this video, we will look into the differences between Employees Provident Fund or EPF and Public Provident Fund or PPF. Provident Fund is an investment fund wherein specified individuals can make the contribution, and a lump sum amount which includes the principal and interest thereon is paid to the holder, either on maturity or on retirement. EPF or Employees Provident Fund refers to an arrangement whereby a certain percentage of the salary of the employees is deducted every month to contribute it towards the EPF account. On the other hand, PPF or Public Provident Fund is one such scheme for the general public, whereby a common man can voluntarily invest money in the fund. EPF and PPF are two savings avenues, in which the investment can be made to get the retirement benefits. So, let's look into the basic differences between EPF and PPF in a tabular form. Difference number 1. EPF expands to Employee Provident Fund, which is a scheme is operated by Employee Provident Fund organization wherein all the employees of an eligible organization drawing salary less than 15,000 has to mandatorily contribute a certain percentage of their income into the fund as savings. On the contrary, PPF stands for Public Provident Fund. As the name suggests, this is an investment scheme for general public whereby all the citizens aged above 18 years can invest their money towards the fund in specific bank branches or post office. Number 2. EPF is regulated by the Employees Provident Fund and Miscellaneous Fund Act, 1952. Conversely, PPF is governed by the Public Provident Fund Scheme, 2019, presently. Number 3. EPF is applicable for all salaried employees of organization registered with Employees Provident Fund organization, whereas PPF is applicable for all the citizens of India, including salaried persons, but excluding non-resident Indians. Number 4. EPF is mandatory in nature, whereas PPF is voluntary in nature. Number 5. Both employee and employer contribute to the EPF, whereas the person himself or herself or parent in case of minor and guardian in case of a person of unsound mind contributes toward PPF. Number 6. In the case of EPF, employees' contribution to EPF is 12% of basic salary along with turnus allowance, and a similar percentage is contributed by the employer. On the contrary, a minimum 500 rupees and maximum 150,000 rupees is allowed to be invested in PPF in a financial year. Number 7. The term of EPF is dependent on how long the individual provides her service to the organization. That is, once he or she resigns, the fund is either transferred to the new organization in case job is switched, or the accumulated sum is withdrawn and the account is closed when the job is left permanently. Further, in the case of retirement, the amount is transferred to the bank account of the concerned individual. On the contrary, PPF has a fixed term of 15 years, after which the person can choose to extend the term for a block of 5 years, or he can withdraw the same and close the account. And, difference number 8, one can avail loan against EPF account after the completion of 5 years of service. However, loan against PPF is available up to 25% of the balance standing in the credit of PPF account, subject to certain conditions are satisfied. Provident Fund is basically a retirement scheme which saves a certain portion of your hard-earned money to have a good sum of savings at the time of emergencies or to avail loan or use it post-retirement. These two are so popular because of the lucrative interest rate a person can reap over the years, which is usually greater than the interest provided by banks, as well as the principal amount and interest thereon is exempt from taxes. The other benefit is the lock-in period, that is, you just have to invest the amount and take its advantage in the future. So, these are the differences between Employees Provident Fund or EPF and Public Provident Fund or PPF. If this lecture was helpful, give it a thumbs up and subscribe to the channel. Thank you.